Okay, let's begin. This is going to be our class on supply and demand. And first, why don't I flip through here? Look at all these things we're going to cover right here. When we're done, you guys are going to know all this stuff. We may have to use more than one. We're probably going to have 2 or 3 different sessions here. But all these items and a few more are going to be covered. You're going to know exactly what we're talking about, what's going on, and the basics of capitalism. And this is really the goal right here. That's one of our, actually, let me highlight that in red. This is one of our main goals right here. How do we use all these different parts, all these different items here with when it comes to the economy, when it comes to supply and demand, and how do we use those when you start working with companies and how you start changing the demand and actually moving demand, understanding what we're going to talk about right now. And I'll tell you, you're going to be ahead of almost every business that I've ever worked with. And just to give you an idea, here, look at how daunting this stuff seems at first, right? All these different terms. It's going to be easy breezy, no problem at all. Okay, so let's first start off and talk about the basics here of supply and demand. My handwriting, again, I'm not used to writing on this thing, so it's going to be, as you guys know, I'm a professional calligraphologist, and I do this on purpose to make sure you guys are paying attention, right? Supply and demand. So here is where everybody starts freaking out when we start our graph here, right? You guys have all seen this before, and it's a little daunting. Don't worry, we're going to go step by step, and if you have any questions, as always, please ask us. Okay, so first we're going to do 2 things right now. We're going to make our supply curve and our demand curve. We're going to start with our demand curve. We're going to make that, let's say, red. Here is our demand curve, and we're going to call this D1. Whenever you see that 1, that's because it's our first one. That's our demand curve. Then we have our supply curve. We're going to make that blue. That comes right here. That's S. Actually, that's not a... It's more like that. Okay, that's S1. So we have our supply and our demand curve. Let me extend this out a little bit. Okay, so we have our supply curve and our demand curve. Now let's come back to our initial, our X and our Y axis here. Okay, so this, we're going to call this 0. Okay, now we have 2 things here. We have a Y-axis, which is right here. Okay, this is our Y-axis, and this is our X-axis. I know some of you guys had an issue with this earlier, so a quick kind of easy way to remember this, if you think of your Y-axis, think of this line right here. This part of the Y that comes down right here, this right here. Think of that right there, and that's always going to mean that basically our vertical axis here is always going to be our Y, okay? And then our X is the other one. We're going to get into the Z, you know, and the other axes later, but right now it's just X and Y. Our Y-axis is always going to be the up and down one, always going to be the vertical one, okay? Now we need to plot, since we have 2 variables here, we have an X and a Y, we need to put 2 different things here. Usually when you see a chart like this, what they're going to have, an economic chart like this, price is going to be over here, and then over here we're going to have quantity, sometimes abbreviated with just a Q, quantity. This is how much of whatever we're talking about. So we have price up here and we have quantity. Now to make this, to show kind of the power and the scale of this thing, with our quantity we're going to say that we can go all the way over to, let's say, 1 billion. And with our price we're going to say we can go all the way up to $1 billion. And that's just to give you an idea of how long, that's not a very good B, is it? We'll make a better B. We got to get rid of all that stuff too. Okay, $1 billion. That's not a good dollar sign, but you guys get the idea. Okay, $1 billion, 1 billion, whatever we're talking about, which we should probably establish. Let's call this shoes. We're talking about shoes right now. So this is the supply and the demand, of shoes. Okay, now we go to 1 billion here on the price, $1 billion, 1 billion shoes. That's just to show you how far we can go either way. We can go, this is universal, it can go up to infinity, but basically this gives you an idea of how far we can go. Just, we can keep going forever. Now let's pick some price points on this curve right here. We're going to start off small just to illustrate a few things. Let's start right here, and let's call this price $5. And then let's go up here and let's call this price $1,000. Okay. Now, already for those of you that have already followed along, you guys have seen some of our other graphing and plot stuff. That looks kind of weird with that Y right there, doesn't it? Let me circle that 5 so that we know that it's just the 5 that we're talking about. So when we're talking about this 5, that's our price, and then this is our $1,000 price up here. Okay? Okay, and as always, if you have any questions or if hopefully this all makes sense, and the X and the Y and that $5 price, try to circle it, and it's going to get a lot sloppier actually as we move along. But we've got $1,000 up there, and we've got $5 down, $1,000 up here, $5 down here. Now, what the law of demand says, that's one of our terms that we need to cover here. The law of demand basically says, let me do this in red, basically says at $1,000, which is right here, okay, and you guys, if you're following along, which we talked about this earlier, you guys want to get those dendrites firing of actually making these charts, so don't just follow along with the math, but actually draw these charts as well. It'll really help too. So when we have our $1,000, and when you're tested, by the way, it's going to be tested on your recreating of these charts. So, and this is like the basic, like we said, the basic like fundamental structure behind all capitalism, all the free market, and understanding just these basics. When we start adding and getting advanced stuff to it, it's going to make a lot of sense. And just understanding these basics, it's amazing how many people don't get this. But okay, the law of demand basically says if we take $1,000 and we come over here, we're going to hit this price here on demand. We take $5 and we plot this over here, and we go all the way to our demand curve right there. And now we have two interesting things. We have two different points. Now, to understand the real difference that this makes, we need to go down. So let's go down here to right there. Boom, we hit that quantity. And then let's come over here to this other demand point, and let's plot this down here. Now, we're along our quantity point at this point, right? Down here. So we need to determine what quantity that's going to be. Let's call this something small. Let's say this is 5. We'll call this a quantity of 5. I'm used to doing this on a board, so it's a little different because I'm running into my labels, but we'll call this 5. Okay? Now let's come over here to our other quantity, and we'll call this, let's say, 100. That is the basic of our supply, our law of demand. Basically, it says that $5, if we follow this demand curve, buyers will want to buy 100 shoes. Okay? And at $1,000, the higher the price, buyers will want to buy 5 shoes. 5 pairs or 5 pairs, because 5 shoes would be just silly, right? So $5 they want to buy 100, at $1,000 they want to buy 5. That's the law of demand. The higher the price, the more up here we go, the higher we go along our y-axis, the less that buyers will generally want to buy. Now there's some exceptions we're going to talk about later, but as a rule of thumb, the law of demand is that the higher the price, the lower that these buyers, the higher the price, the less that buyers will want to buy. So as we go from 5 to 1,000, look what happens. We get less and less quantity, and this graph, this chart, actually, the true demand, it keeps going like this. It keeps going closer and closer to 0 as the price goes up. Okay? Now, since we have another guy on here, our supply curve, let's look at the same price points, 1,005, and look what happens to our supply curve. So let's go to 1,000. We're going to do this in blue, and we come out here, and we've got this point out here, right? Then we take 5 and we come out here, but look what happens. We hit the supply curve way over here, right? So now let's come down. Let's bring this quantity down here. Let's take this quantity of $1,000 from suppliers and let's bring it down. And these are really close, actually. So what do we call this point right here? And what do we call that point right there on the supply curve? We'll have to give these some values. Let's call this, let's say, 3. Wow, this is really close to mine. Could have been better with that. And we'll call that, I don't know, 90, let's say. Okay, so we have 90 and 3. This basically tells us that at $5, suppliers are going to want to make 3 pairs of shoes, and at $1,000 they're going to want to make 90 pairs of shoes. So it's an inverse relationship, meaning that as the price goes higher, as we move higher along the y-axis, we see that suppliers actually want to make more shoes. They want to build, they want to make more, they want to sell because it's a higher price, more profit, more gross revenue at least. They want to make more. So at 1,000 they want to make 90. At $5 they want to make 3. Okay. Now we are actually, I didn't think we'd be moving this close to our time limit here, but let's cover a few more items here. So that kind of gives us an idea of the difference in the attitudes of the suppliers and the attitudes of the buyers, the people who want to buy shoes, the people who make shoes, the people who demand, the buyers, the consumers who want shoes. Now let's do this next part in purple here. Okay, so we have some very interesting things that happen up here. So if we look right here, at this point right here, what we have is that suppliers are making more shoes, right? They're making more shoes than buyers are buying. They are making 90, but buyers are only buying 5. That means we have 85 left over. That's called a surplus because we have more shoes than buyers want to buy them. And in this case, our surplus is 85. Okay, now let's come down here and we see the exact opposite thing happening. Because down here we have buyers wanting to buy 100. That's in red, right? The demand is at 100, but suppliers only want to make 3. Okay, so that gives us a 97, and this is what's called a shortage. Okay, now shortage, let me spell that a little neater. Hopefully this will be neater. Short age. It's an easy way to learn how to spell it. Shortage, okay? So we have a shortage over there, and then up here we have a surplus. So that's what happens when there's basically an incongruency in the suppliers and the demand. Now let's cover the last item we're going to go over in this video, and then we'll stop. Right here, you're probably wondering, let me get the right color, let's do green. You're probably wondering, Oz, what is this wonderful place here in the center? Right? This is something called equilibrium. I could do that better. Equilibrium. Equilibrium. I'm not going to have space to write it. Okay, equilibrium. Well, if you want to see the spelling on it, let's come back here. Where is it? Right here. Okay, equilibrium. What that means, and actually we're going to cover several of these items here, because what happened was this guy, Adam Smith, wrote a book called Wealth of Nations. In it, he talked about this idea that everything that happens in here, that instead of what's called feudalism, which is what it used to be, he was considered the father of modern capitalism, which gets thrown around a lot. But basically, the idea is very simple, and people have different definitions of it, capitalism. But it basically comes down to the fact that the government intervention, or some, like a king. It used to be feudalism, then came capitalism. In the Netherlands, like Amsterdam, was considered the first place of capitalism. But basically, what that means is that a king doesn't need to come in and say, okay, you guys make shoes at this price and you guys buy shoes at this price. A king doesn't have to do that, or the government doesn't have to come in and tell everyone what to do. Anybody can pretty much do whatever the hell they want. And what'll happen is there's an invisible hand here where if you try to make shoes and you try to sell them for $1 billion, you're probably not going to sell very many shoes. Or in some cases you will. We're going to talk about the cases where that would actually make more demand. But generally speaking, to the mass public, that's not going to be too appealing. But you can try. And what will happen is that an invisible hand will come in. The market will tell you that that's not a price buyers want to buy at. So what happens is that to avoid having too many surpluses or too many shortages, the market will kind of massage. You can do whatever you want. People are able to do whatever they want. And somehow we'll come to some median agreement, and that's called equilibrium. Now, if we plot equilibrium out here, let's call this price, I don't know, what do you want? Let's say 20. And let's call this down here, if you guys can read all that craziness down there, it's someplace between 5 and 90. Let's say 30? Is that fair? Let's call it 30. So what that means is that anybody entering this shoe market the buyers and sellers are going to come to some type of understanding that $20 is a good price for shoes, and buyers will want to demand, the demand here, because, right, the demand intersects here, will be about 30, and suppliers are okay. They're willing to sell shoes for $20. They're willing to sell, they want to make about 30 pairs of shoes. And so that's what develops this idea of equilibrium. The market kind of, it massages it together, and we come up with an equilibrium price. This is the fundamental idea behind the invisible hand down here, and this concept of laissez-faire, which basically means let it be. And this is the idea that nobody should intervene. It's considered to be, it's taken to be let it be, but let do, let be, the actual translation. But basically means don't mess with any of this stuff. Let the buyers decide what the price is. Let the sellers decide, and it'll come together automatically. And what were some of our other terms before we close out here that we covered? Okay, we went over the supply curve, the demand curve, surplus, shortage, and this last laissez-faire in the free market. This whole model here is the free market. That's what determines what a free market. Well, that went away. As you guys are witnessing my increasing proficiency with this style. Basically, this entire idea of supply and demand, this entire concept here, is based on this whole free market that, do whatever you want, laissez-faire, let it go, and eventually the market will find a price that is suitable for everybody. Okay, these other items here, we're going to talk about elasticity and some of these other items, and then the most important episode for you builders out there is going to be when we talk about changing demand and the basics of how to do that to grow companies. So hopefully that all makes sense. If you have questions about any of these items that we covered here, let me know, and we will make sure that we get your questions answered. That is the basics of the supply and demand curve. Hope that helps.